All right, everyone, thank you for your patience there, and welcome back to session 2. Just a reminder to check in for the people in the room, and anyone online, you're all good. We've got Nathan presenting now on global real estate, and particularly G-REITs, I believe. So again, thank you to Nathan for organising the Bennelong rooms here for us to use in person. So throw over to you, Nathan, and anyone ask any questions throughout the process. I'll Nathan.
Great. Well, thank you, everyone, and thanks everyone for dialing in that isn't in the office with us here at Bennelong. So not clicking.
Sorry, Nathan. I might have stuff, Jeff.
It's all right. There we go. Yeah, so today was really just a bit of a deep dive into global real estate and just giving people a bit more of a feel for global real estate. It's probably one of those asset classes where, you know, we hear a lot about global equities, we hear a lot about Australian equities, we hear a lot about fixed income, but we probably, even though we all either live in our own houses or we rent our own houses or we're using real estate every day, whether it's going into the office to work or going to shopping centres or effectively using data centres or retired living, it's something that's fundamentally part of everyday life, but it probably doesn't have as much profile as some of those other asset classes that we see in the market. So today was just really a little bit of a deeper dive into global real estate and ultimately where we think it might effectively have a position in a portfolio or as part of your overall allocations. So really just working through today, and just this is sort of some of the things that I'll touch on and why we think that global real estate's probably in a really sweet spot now to be considered as something to invest in your portfolios, where we think, you know, valuations have been hit quite significantly, whether we've had the Magnificent Seven have such a strong run and that's taken away from global REITs, etc. We just think today, now is the time that it's something to consider as part of your portfolio. So what we'll sort of, some of the themes we'll touch on here is, you know, it is a deep and diverse opportunity set. There's exciting themes playing out there, and some of those aren't available through A-REITs, so Australian REITs relative to global REITs. So there's a lot more of a diverse opportunity set there. Surprisingly, historically, it's outperformed global equities, but in recent years, it's underperformed significantly. And that sort of touches back into whether it's been a rising interest rate environment that's hurt REITs, or particularly technology and the Magnificent Seven that have really inflated what the global equity markets have done in recent times. Some of the negative factors that have driven this reversing, subsectors within real estate that can actually be a little bit more recession-proof, and we think there has been talk about a potential recessionary environment in America at some point, and we think that, you know, and potentially that flowing onto Australia and other parts of the world, there are parts of the global real estate market that can just exhibit resilience through some of those periods of more recessionary type environments. So we think that's a good consideration as well. Impacts on supply. The cost of building has gone up significantly, as we all know, particularly if anyone's built a house or an apartment in the last few years. Everything's gone up significantly in price. So what that's meant is there's less construction going on, supply's fallen, as a result, prices are potentially going to rise from here as well. And as I said, the valuation at the moment is compelling with where REIT prices have been over the last few years. So quick overview, what is listed real estate? I think it's just important to sort of describe or explain what listed real estate is and where it's really different, A-REITs relative to global REITs. So Australian REITs is a very, very concentrated part of the market. So you can see on the chart, on the bar on the left-hand side, that's a reflection of the A-REIT market. So across that market, you've got industrial REITs, retail REITs and office REITs. So whether it's the offices we work in, the shopping centres we shop in, or sort of, you know, the storage facilities, etc., in the industrial space, account for about 70% of the overall market. So it's very concentrated. And of the 24% that fall in the top box of diversified REITs, they're actually effectively a combination of industrial, retail and office. So really what you've got is incredible concentration across three subsectors of the A-REIT market relative to the global REIT market, where you can see that those respective subsectors have a much lower allocation. And then you also have things like storage, healthcare, aged living, a variety of other subsectors that give you much more diversification in your allocation if you're looking at A-REITs relative to global REITs. And particularly what's important to sort of highlight there is if we are moving into that recessionary type environment, those, whether it's industrial, retail and office, it won't surprise you that they're probably a little bit more prone to suffering from recessions relative to sectors such as aged care or storage that are probably a little bit more recession proof. So we just think a complete A-REIT exposure is potentially less diverse and more susceptible to sort of suffering from some of those recessionary type environments. Looking then, and this is really highlighting where the difference is between the global REIT index and the A-REIT index. And these are a number of the subsectors, so apartment and single family housing for rent, student accommodation, life science and laboratories, healthcare, manufactured housing, data centres and storage. And obviously the one we're hearing a lot about at the moment is data centres, and everyone wants to set up a data centre and everything going on there. But importantly, effectively the first four subsectors you can't access here in Australia. So you're really cut off from having any exposure to, or any significant exposure to healthcare, apartments, student accommodation and life science. And then even in manufactured housing, for example, there's only two suppliers there in Australia, Ingenia and Lifestyle Communities, relative to multiples in the US or Europe or Canada and areas. Same in storage, you've only got two Australian storage offerings and you've got about 15 around the rest of the world in the global REIT market as well. Same with obviously data centres, you've got Goodman, NextDC and DigiCo set up here in Australia, but you've got a much more diverse opportunity set overseas. And one of the really compelling positions we think for a consideration of global REITs is the ageing demographic that we've got in developed markets in particular, and also in non-developed markets or emerging markets, but particularly in developed markets where that is offering incredible opportunities in areas such as healthcare, apartment, single family living, aged care, etc., where we think as populations around the world are ageing, that's going to become a lot more of an opportunity set for people in the years ahead. So sort of when we sort of step back and look at the global REIT market relative to the ASX, US REITs or A-REITs as an example, you can see whether it's the bar on the left-hand side of the global REIT developed market relative to the bar on the far right, the A-REIT market, how much larger it is globally than in Australia. So in Australia, you're sort of looking at about $150 billion. Globally, you're looking at over $3 trillion. And to give you a context of that, the listed global REIT market is larger by about, or call it roughly a half to two-thirds of $1 billion than the Australian, the ASX 200. So it's really a large opportunity set here with many, many opportunities there. And if you look at it, about two-thirds of the opportunity sets in the US and about one-third is the rest of the world, which is a little bit reflective of the the global equity index, but dominated by the US, but still a lot of opportunity set. And we're finding incredible opportunities in the likes of Europe and Canada as an example relative to the US as well. So we think it's a compelling opportunity relative to the very small opportunity that you get here in Australia. Sort of an overview now of how has listed property performed. And I did start to say, surprisingly, global listed real estate has outperformed historically global equities, which surprises a number of people. But what we find with real estate is it's a good store of value. So at the end of the day, you look at obsolescence. If you had a BlackBerry 10 or 15 years ago, that's now obsolete. If you own a house or an apartment or a shopping centre, at the end of the day, you might need to do some work on it, but you've always got that store of value. So it always has that value there. Whereas as we've seen with multiple global equity stocks over the years, they can become obsolete and basically lose all of their value. If I was to pick out two sort of points on those two lines. If you look at about July 1999, that's that about a third of the way across the chart where the blue line goes above the orange line. So equity significantly outperformed global real estate. That was the dot-com boom. And you can see when the dot-com busted that line reverted back down, and then REITs obviously accelerated again. And then when you see the other dispersion, it's right at the end of the line where that is as I say, that's the driver of the Magnificent Seven that's really driven global equities over the last few years in particular. And an environment where interest rates had been rising significantly and have had an impact on real estate, which can be a little bit susceptible to rates at times. But that gap is now, as you can see, they're starting to narrow, and I'll sort of evidence what's happened in the last little while that's led to that gap closing. And what this chart's showing you is EBITDA is a multiple of real estate minus equity. So you can see here, looking at the far side, this is the cheapest that global REITs have been in history, effectively. So you look at the peaks, and through the GFC and COVID, we're at levels below those two levels. So we think that this is absolutely a compelling opportunity to consider REITs. As I said, one of the drivers of that has been interest rates. And as we feel that we are moving into a potentially a lower interest rate environment over the years ahead, we think that that opportunity set's really going to expand from there and present significant opportunities to consider REITs as part of your portfolio. And as I touched on, where resiliency can be offered by REITs relative to other areas is things like manufactured housing and data centres, where we continue to need that. Supply is relatively constrained. We think that that opportunity set is really, really significant over time. So we're seeing construction costs rising, and that's making it more expensive to bring new supply on. So if you've got existing supply there and you've got existing capacity, you're going to potentially be in a very good position. One of the things that sort of is talked about in global REITs or potentially global infrastructure is that it can operate as a bond proxy. And what we've probably seen in the last little while, and the bar on the left there is showing calendar year 2024, where there was a significant negative correlation between bond yields and REIT prices. So really they were in line, but that was an absolute anomaly relative to history, where over time, when you look from 2000 to 2024, that distinction was completely the opposite. So you had a significant amount of opportunity there. And really that's driven by, at the end of the day, REIT businesses generate earnings and are reflected, or the stock prices are reflected by the earnings that are generated there. So that has been an anomaly, I'm having trouble with that word, anomaly over the last 12 to 24 months, but we think that that's reverting now, and we think it's going to be a really great opportunity set. Having touched on that, what has driven global equities, as I touched on earlier on, it's really been the AI trade. We've all heard about it significantly. This is reflecting total returns from calendar year 2023 into 2024. And you can see there, NVIDIA, absolute standout, Meta, Amazon, Google, Apple, and Microsoft have absolutely ridden this wave. The one that's left out is Tesla, because they're probably a little bit less AI driven, but this is what we refer to obviously as the Magnificent Seven, and that's been a significant driver. And what you have seen is that has, particularly over the last sort of year and a half or so, has really, and even pre that as well, really driven global equity returns that have created that incredible dispersion between what they've delivered and what global real estate's delivered. So why global real estate now? I suppose that's the key question there. So even though we've had the incredible sell-off in global real estate, you can see on the chart on the left there that operationally they've still been incredibly solid. So still net operating income growth has been strong. This is an environment where office has been down in double digits. So even with that, and office being such a significant drag, net operating income has still grown. And what you can see on the right-hand side is US listed real estate. That's the occupancy rate across all of the all the subsectors in the US, and that's now close to 94%. So whether it's shopping centres, whether it's apartments, whether it's storage facilities, etc., we've gone from a significant, like when we really dropped post-COVID, to really growing back to close to full capacity there as well. And part of that capacity or that occupancy rising so significantly is the lack of supply that's in the marketplace at the moment. So occupancies are rising as there's less and less available capacity, being driven by the costs of construction at the moment in particular, or interest rates having been incredibly high previously. And so this is the reflection of central banks. The cutting cycle has sort of started now, and you can see that at the bottom part of the chart, whether it's the US, Europe, the UK or Canada, we've had significant cuts in rates over recent times. So what we're finding now is that thematic we think is more than likely going to continue. And really that is creating a very, very favourable environment for global REITs to perform well in that sort of cost-cutting environment. So we touched a little bit earlier on about our special friend, I think I referred to him, in America, and what's happened with the US economy in particular since Donald Trump has come into power or come back into power. So this is reflecting market turbulence that's happened post-Trump's inauguration on the 20th of January. So what you can see there is the Magnificent Seven is down around 5% between the 20th of January to the 27th of May. Now, that was a more extreme position until there's been a more recent correction in the Magnificent Seven. So that number was actually down more at an extreme level before the recent sort of correction in the Magnificent Seven valuations. Global equities are down about 1.3%, but global real estate's up nearly 4.5%. So it has exhibited that resiliency through there. It has been impacted less by some of the noise and the volatility that's arisen because of Trump's reversals on a number of things, or Trump's tariff policies, and etc. So how does that sort of position the portfolio for resilience and defensiveness, I think, is the position where you might be thinking, if we're going to continue to go through this cycle of volatility and we are looking for some more defensiveness in our portfolios, this is a reflection of what would potentially happen again if we went into more of a recessionary environment. And what this is showing is US REIT share price performance from February 2007 to July 2010. So basically when we're going right through the middle of the GFC, when we all thought the world was ending, and as Ron Sargent touched on earlier on, we don't think the position's as extreme now. We think the world's in a better place even with the volatility, but it will come with volatility, and it has already come with a downturn in the global equity prices. This has shown you what US REITs did during the GFC. So as you can see, starting at the right-hand point, data storage, incredible growth, net leasing, incredible growth, student accommodation, healthcare, manufactured homes, etc. And then you had the S&P 500 falling by, roughly 16, 17%. The two or the three that really did suffer through that period from a REIT perspective were life science and office, which are basically office or buildings, or industrial as well. So, industrial facilities, etc. So that's not on the chart, but they were the three. But what you saw is that really defensive characteristics come through in your portfolio. So in your overall allocation, it gives you sort of more ballast and a bit more defensiveness to your portfolio. So we think if we are going into that environment, it might be a nice time to consider or add to your allocation in a global real estate perspective.
Just on to slide 4, when we're just doing those those comparisons here of the recent turbulence, do you have data to show, like, from the peak, if it was 20th of Jan, pretty much the peak of the market, to the bottom, which was 6th of April or something like that, in comparison to the S&P as well as the Mag 7, what the G-REITs did?
I'm not sure. I could get you that. Most definitely get you that data to see what the split was between over the two periods there. We'd definitely be able to do that. But the one thing that the guys had told me was that Magnificent Seven position was down much more significantly than
probably like negative 30 or something.
I can definitely get you that data about what did it get to at the absolute lowest point for the Mag 7, and what was the highest that REITs got up to, if it got more significant than 4.4. But absolutely. And it has been volatile. And what we found, just using our strategy as a comparison, was when Trump was elected in November, before his inauguration, what you saw was US markets go really, really strongly. And that was reflective. Our portfolio suffered through that period because we have a greater level of Canadian or European exposure. But what it effectively did sort of post his inauguration was flip on its head, where everyone it was all US on, it became all US off, and our portfolio really recovered well. So you've sort of seen a little bit the same, where the Mag 7 was running really hot, and then his inauguration has led to it falling off. But it has corrected somewhat, and I think I saw overnight or in the last day or two, NVIDIA had a really strong result. So, that'll be reflected in that probably narrowing the gap a little bit there as well. But it is down quite significantly. And really the concern, I suppose, with the Magnificent Seven is how much of the global index it now accounts for. It really is driving what is happening with global equities overall. So that is the concern, and why we think you need to have a more balanced approach to global equities more broadly. So just sort of touching on one of the, I won't touch on everything, whether it's storage or aged care, etc. Retail. I'm happy to take any questions on that, storage, etc. But one of the areas that we're finding is an absolutely fantastic opportunity set in global REITs is manufactured housing, and this is something that's pretty foreign to us here in Australia. But what manufactured housing is, effectively, you live in New York, you decide that you're about to retire or you're retiring, you don't want to live in the cold weather anymore, probably a bit like moving from Melbourne to Queensland. And what you decide to do is you sell your house in New York, you buy a house in Florida, you pay about $100,000 to $150,000 for the house, and you put the house on the plot of land run by the company. So basically you then pay a rent. So you pay for the house, and then you pay a rent to have that there every day. And basically that's your living. So it's a manufactured house effectively. And what we're finding with this market is, because of the aging population, particularly in the US, is the demand for this is going through the roof. You've got incredibly wealthy people that are wanting to move to areas like Florida or California. And one of the challenges, and why we think it's such an opportunity set, is there's just not that much land for these companies to find these areas to set up these. So whilst you've got this incredible demand coming down, you've got limited supply. While you've got construction costs, etc., having risen so much, that is the whole supply-demand equation. This is going to be an absolute incredible opportunity set. And you can see that there in the growth level. So even as you sort of went through the GFC, you've seen Sun that their earnings have still stayed resilient and strong, whilst you've had US apartment growth being the blue bar falling in 09, 010 and 2020, and unemployment going up and down, but spiking at various levels. You've still had this strong growth stream coming through their earnings as well. So we don't see that abating. We think, if anything, that's going to get more extreme just because of the level of demand for these sorts of facilities. And you can see it here, actually. This is the new supply that's come into the US in the last sort of 10 odd years now. Apartment growth has been incredibly low, sort of only at about 2%. And manufactured housing has been effectively zero. So while you've got this continued pent-up demand that's going through for this sort of accommodation, it's really driving up those earnings, and what you're seeing is that reflected in stock prices. This is sort of a reflection here of the new supply, and this is actually in Canada. And in Canada, we're finding fantastic opportunities, and this is actually senior housing, so a little bit different, but really playing once again on that age demographic. And what you're seeing here is the cost of build has, or the compound annual growth rate, of the market there, and new supply in the market as well. And you can see that no new supply is coming on, and if anything, when stock is becoming obsolete and needs to be replaced, because of the cost to build now, it's not actually being replaced, and that's continuing to put significant pressure on prices because of that lack of new supply that's coming into the market. And this is the reflection of that. This is the change in the construction costs that have happened. So construction costs have outpaced market rent growth. So costs have gone up by about 50%, which is similar to what we've seen here in Australia, where the cost of building has just gone up so significantly that it's becoming very difficult to justify these new construction projects. And what you'd need, and what will drive this happening in Canada's or Canadian senior housing as an example, is you'd need rents to rise by 20 to 30% to justify that new construction. So even if you have rents rise by 10 or 15%, it's not enough to switch that equation to start new construction. But if rents are going up by 10 or 15%, the existing stockholders are doing incredibly well. So this lack of supply is working for the companies that are already positioned in the portfolios. And that's where we think that that's a fantastic opportunity set, because the ageing population, whether it's Australia, whether it's Canada, whether it's the US and other parts of the world, has been a really significant driver. And just in closing, as I said, this is sort of growth in senior housing as well. And these are three stocks that we hold in the portfolio. And you can see there the growth in their portfolios over the last few years has been absolutely significant. And as you can see on the chart on the right, senior housing, where the level of occupancy has continued to rise, and at some point that's going to sort of reach its peak. And if no new construction has come on, we think those level of earnings on the left-hand side will only continue to grow over time. So we think there's incredible opportunity sets. That's sort of some of the broad overview, without touching on areas such as storage, life science, data centres, etc., where there is just a complete lack of supply at the moment because of construction costs, where we think in a falling interest rate environment with construction costs being so high, global real estate will be a potentially fantastic opportunity set over the next few years ahead. Happy to take sort of any questions on that. To sort of using a contrast, like if you look at our portfolio, we, won't surprise you, we're very lowly allocated to office, but we have a very high, or a significantly high allocation to storage, for example. So storage facilities through Europe and the US, particularly in Europe, where, the level, I think it's 1 square metre per person, 9 square metres per person is taken up in the US. It's something like 3 in Europe. So the opportunity set in Europe in storage is incredibly high relative to the market in the US. It's already quite mature. And what you're finding with the storage facility, unlike an office building, that probably about 30% of your costs go on maintenance of the building. It's about 5 cents in the dollar in storage. So you really, every so often, give it a coat of paint, change a few doors, and basically it generates significant earnings over time. And because we've had that rising, challenging environment, even though the earnings of a lot of these real estate companies have been incredibly strong, and as strong as they've been, the market has really been hammered from a cost perspective, or a pricing perspective. So that gap has really widened, and we think that will normalise and present significant opportunities in the years ahead. Oh, yeah, no worries.
Well, thank you, Nathan, for that presentation. It's certainly a good eye-opener to see, what's available and what's out there. And again, it puts into perspective how small the A-REIT market is as well, and the opportunities out there. And I know that Zenith, our research partner, has the same sort of thought process, that G-REITs are probably the place for the opportunity rather than A-REITs at the moment as well. So I'll just remind everyone, if they can please submit their feedback for the session, and then we'll jump into our next link for the following session. Thank you.
Percentage. Would we say